Okay, here's the chapter on statement of cash flows. Statement of cash flows. So, of course, this is pre the conceptual video. So you've watched the three videos leading to this. So this is literally going to be video 4 or part 4. I think there are three videos leading on to this. It might be part 5. It doesn't really matter. But let's begin. So now that I've talked about how we build, if you like, how we arrive at the individual parts of the cash flow, probably I spent more time on the cash flow from operations, but we can now look at the chapter itself and see the additions that we see at this level. And just going through it step by step. So, statement of cash flows, again, here, this first bit will probably be all theoretical, and then in the next video, we'll do an example. So what are the objectives? Again, the whole idea is about trying to understand the movements from one year to the next. So providing information about the historical changes in cash and cash equivalents by means of a statement of cash flow, and to look and to be able to break this down, because we sort of agree, right, that we can only have cash movements from three areas: operations, investing, and financing. So as I said earlier on in the earlier videos, you have this. What you have now is that, yes, people like to look at profitability, and yes, profitability is a great signal as to how well an organization is doing. But in order to pay a dividend, it's important that you have cash. Now, just because we look at your cash book, let me just because we look in your bank account and we see money there, does not mean that money has come from trade. Because first of all, we should be paying dividends out of retained profits, but cash retained profits that have been generated, and there's actual cash, not just the fact that we've sold goods on credit and we're recognizing a profit. Forgive me, I'm just creating some slides so that when I'm about to write, it'll make sense. So you see, you can have cash here of 2,000 in 2008, and you have here cash in 2009, cash of 3,000. We cannot assume all of this is profit turned cash. In fact, this might be entirely a new raise of equity or loan. So investors want to know what is the composition? What is the composition of that cash? And so deriving this information involves the user making assessments of future cash flows. Future cash flows are regarded in financial management theory, and again, this is a main determinant for the worth of a business. As we said earlier on, there are three parts to this: operating activities, which we sort of do via reconciling from profit, and in those videos you saw me reconciling profit to cash flow from operations, and then we adjust for finance costs and taxation, and we're done. Of course, again, like I say in this chapter, what we see are the new additions, the new depreciations, or the new amortizations, and the new, if you like, anything that can basically go in my income statement that wouldn't go in my cash, but in my operational statement. Provisions, things like that. We see all those sort of things, and then we adjust them as well. Then we do cash flow from investing and financing, which are pretty straight. That's literally just you're buying some new assets, you're paying out, you're receiving money on some old assets, and it's those T accounts that you need to be happy with. This classification, of course, it says require attention because we have to be very clear about putting them under different headings. Something you will notice is that finance costs are considered to be operational, and when we deal with it, that finance payments under operations, but the actual loan movements themselves we deal with under financing activities. Right, and it's just an awareness of it, really. It doesn't really matter of course, the overall total won't matter in the end. Of course not. The overall movement won't matter in the end, but it's important to do that. Right. Again, like I said, this first video will be quite theoretical. So the key point here is, and you'll see from my previous videos, is sort of saying that one reason why the statement of cash flows are considered is because the final profit figures are easy to manipulate. We have in there depreciation, allowance for receivables, inventory valuation. So definitely the point is that you can't change cash. Cash is cash. As opposed to profit, you can manipulate it and adjust it by using different policies. And of course, there's a lot of judgment, of course, isn't there, that goes into that. Okay, let's look at some further definitions. We talk about cash. So short-term, highly liquid investments, convertible to cash easily. Um, Again, they talk about here the direct method is no longer included in the FR syllabus because we use what's referred to as the indirect method. So the indirect method requires us, again, you can see here, to find cash from operations by adjusting profit from operations. Look at my previous videos, you will see that we have adjusted profit from operations for depreciation. I'll take the normal ones we know. So, well, this is all about where you start from. So if you're going all the way to profit after tax, you're literally working your way back upwards. So you're saying profit after tax, add back taxation, as in tax for the year, not tax paid. Just get back to profit from operations. Just get back to profit from operations. So you have profit before, and I don't think it matters how you label it. I think what's important is that you get to profit from operations and then adjust. So you could technically look at it this way. You could say, well, profit before tax, I'm going to get back up to profit from operations. So I'm going to adjust, if you like, by adding back finance costs. Exactly the same principle. If you've seen the previous videos that I talk about when I show you the principle behind this, of course, adding finance costs, taking away investment income, adding depreciation. I talked about this. Deducting any profit on sale on non-current assets. I talked about this in the previous video, and the reverse, adding any loss on sale of non-current assets. Now, of course, think of a provision. A provision is an expense you put through the income statement, right? But nothing happens in the bank. So when you put through a provision, you're hitting yourself with an expense. So adding back that, well, of course, the reverse as well. If you release the provision, you have income. Technically, when I say income in every sense of the word, an up movement of profit. So I need to reduce that profit to bring it back to my cash reconciliation. Government grant amortization is really important. This when you debit bank, you credit deferred income, and with government grants, you release that income into the income statement. That release, if you like, is a type of amortization. You're releasing it against the expenses. It's not actually cash. The cash is in the bank. We see it. So you need to adjust, if you like. We need to adjust that and get rid of that. That's affecting our profits as well. And just doing the needful if it is the other way. If you are releasing it, most of which is what you're doing actually, of course. So if you're releasing it, it's an income, so you need to deduct it, right? Because when you say this, and you will see it when you have this is the initial debit bank credit deferred income. So you have deferred income. I mean, I'm not interested in this. I'm trying to reconcile my profit figure. So what you do is, if you remember, you release a bit of this every year, maybe over 3 years, equally year 1, year 2, year 3. So when you release this, it now comes into the profit statement as income, right? And that has boosted your profits. So the whole aim is to reduce that, if you like, to come back. Because if I'm saying that profit is equal to cash, remember from my very first initial cash discussion, if I'm saying profit is equal to cash and I suddenly boost my profits up, all I get back to cash, all I need to do is to deduct it. But go back to that first video. On the principles, which is why I think that's important to watch. And then, of course, we have all the changes. Of course, any accrual movements. These are all important. Again, so we'll see examples of that, and prepayments, any movements in there as well. Of course, these are expenses and things you're putting in that aren't actually hitting the cash book. Right, and then of course we have our 3 working capital things which I talked about, increase or decrease in inventory. Please watch the video. The key point now is I'll just talk straight away about what happens when we have an increase in inventory, money's going out. When we have a decrease, money's coming in. When we have an increase in trade receivable, money's going out. When we have a decrease, money's coming in. When we have an increase in trade payables, money's coming in, and when we have a decrease, we have money going out. So I talk about that in the earlier videos. Since this method starts with profit before tax, I don't have a problem with that. I mean, I think you could have gotten to here, profit before tax, adjusted for finance costs and investment income, and called it profit from operations. Then you could have then adjusted onwards Doesn't really matter. The key point is to take the profit figure you're given and start working upwards. Right. So this is where we are. Non-cash, again, the key point here, just highlighting all of this, is that I'm on 10 minutes already. Any non-cash items are adjusted in order to arrive at cash generated from operations, of course. Non-cash expenses are added back to remove them, such as depreciation, loss on disposal. Non-cash incomes are deducted, and adjustments are made to working capital, if you like, as well. Yes, and here's what the statement looks like. Of course, you can see that once you've done all of that work, all of this work, think of it as an appendix. You do all of this work just to arrive at cash flow, cash generated from operations. You now come to the actual cash flow statement. You now have your cash flow statement here. So you have cash flow from operations, and that's that. So this figure here is a sum figure of everything that's happened before. So we now just do everything as normal. We now deduct interest, deduct tax, just carry on as normal now. Cash flow from operations. I'm just trying to get to my final bank figure. And then you deduct that and you have net cash from operating activities. And then, of course, we deal with the cash flow from investing. So did we buy some new PPE? Did we sell some? Investing activities. In this section, we put in government grants, interest received. This is interest received on investing activities. So on investing activities, any interest received and any dividends received, the money actually coming in. It's just what it is. Just thinking of picking up on all the money coming in, cash coming in here. Dividends, of course, will be cash. And then we have that. And then finally, cash flow from financing, pretty straight as well. Any issue of shares, money coming in. So remember to take ordinary share capital and share premium, because that's all the money coming in, isn't it? Debit, bank, and credit. Ordinary share and share premium. Proceeds from long-term borrowings. If you pay off any lease liabilities, so payments of lease liabilities. So these are considered to be financing activities, because remember, of course, when you look at the leases chapter, really all you're doing is taking a loan from the very same company that gave you the asset, and if you're paying out any dividends, and that's kind of the principle, really. Right, and so yes, we've talked about this, the reconciliation of cash, interest paid, and tax paid. And of course, all we're doing is just putting out these double entries to see. So really, it's about what are the brought forward figures, what are the carried down figures, what are the brought forward figures, what are the carried down figures, and what is the entry for the year. And then we find the difference, and we can find the cash for the year. So just showing you it's the same principle through everything. Here's interest accrued. Interest accrued. I'll have an opening balance, opening bow. I'll have a closing balance, closing bow. Then I will say, oh, what's the finance cost for the year? Well, debit finance cost, credit accrual, right? So it means, right, that if I started off the year like any payable with this, it accrues some more. You must have paid a certain amount to have this as the closing balance. This is the figure I'm looking for. What finance cost did I pay? Or whatever it is, it doesn't really matter. What did I pay? It's always the balance you're looking for, and that's the skill. That's the skill that you're trying to acquire. And yes, I think that's kind of, you can see again. I think I might have done this in the previous videos, but again, that principle of PPE. Just look at this with tax paid as well. It's the same thing. Liabilities on the right side. Debit taxation expense, credit taxation charge. Let's just do it again here, because like I say, this is just an exercise. This is taking slightly longer than I wanted. But what do you have here? You have your tax liability, you have your opening balance, normal tax charge, normal tax, or then you have deferred tax as well, X. And then what you then do is, of course, you have your tax expense, debit your tax expense, and credit your tax liability. You now have your carried down figures of ordinary tax payable and deferred tax payable. They're together, and so of course the difference here must be what you paid. That's the way it always is. And so once we need to get those figures, we can just plug them in to the equation. Right, let's look at the cash flow from investing. Probably the most popular one you're going to meet is this one here with your PPE. your PPE. Let's look at what happens there with your property, plant, and equipment. You have your situation. If you're trying to find out what cash did you pay out for your assets, what you have here, of course, is that you have an opening balance of your PPE. So opening balance, they'll give you a closing balance, of course. And of course, what would have happened was that you would have a classic scenario of you disposed a few things, so disposal. So that would be credit PPE, and you'd have your disposal account, and you have your X here, of course. And then what you would then have, I guess, naturally is you might then, of course, you will have your depreciation charge for the year. So your depreciation charge, of course, depreciation there, and of course you would have your depreciation here as well, of course, because really, call it accumulated or whatever you like, it is bringing down the carrying value of this thing, isn't it? So you start with this, you get rid of that. So you must have bought some new assets, depreciated all of them, and other students, you can have a revaluation. So you can have a revaluation here, adding on to that, and then you have your other comprehensive income. Of course, this will flow later on to the valuation reserve. But the point is that you're putting in everything to find out what is this missing figure. Ultimately, is what we're trying to look for here. What is this missing figure? I've done 16 minutes. That's too long. So let's quickly finish that part of the syllabus. And then financing, of course, is literally just doing exactly the same thing. Carried down, brought down, carried down, brought down, and you arrive at the answer. So in the next video, we'll look at the first TYU. Okay.